Welcome back to Off of the Hamster Wheel, where I bring you guys along with me for my journey to financial freedom. Today, I'm going to show you guys how to choose your covered call strike price by analyzing 3 market conditions to maximize your premiums. The 3 market conditions that we are going to talk about today are the bull market, the flat market, and the bear market. For the bull market, there's a couple pros and a couple cons. For the pros, we see a greater return from our shares due to the share price consistently rising during the bull market. Premiums typically tend to be higher due to the increased share price, as well as the volatility of the market going up, as well as because of those higher premiums, we get to choose farther out strikes, thus allowing us to have more gain in our share price as well as make more money from our premiums. Some of the cons are that the market is typically more volatile than in a flat market, so we have to kind of do a little bit more guessing as well as expect a lot more price runs. The share cost when you reinvest your premiums typically is more, so you get less for your investment or less bang for your buck, as well as you can lose potential return from price runs that go past your strike price. Typically, in a bull market, you have to choose further out strikes as well for less premium, even though the premiums tend to be higher for all call options. But because you don't want to miss out on share price increase or potential increase in share price, you typically will choose that further out strike. Now, I want to show you guys how to choose your strike price in a bull market. This is typically how I do it. I will find the average movement per week of a stock market over the whole year. This is typically easy to do by going onto Google, looking at a 5-year chart and just kind of charting it out yourself, writing the numbers maybe in Excel or on a piece of paper, and then doing a simple calculation to find the average price. I do not typically sell covered calls during volatile events or until after the volatile event. Let's say they release their earnings report or CPI numbers come out, or we have a Fed meeting where we're about to see the interest rates go up. I don't like to sell covered calls during that time until after I see what the market is doing, because sometimes the market will react aggressively and you'll lose out a lot of potential gain. Sometimes it doesn't work in your favor and your shares go down. However, it's the chance that you have to take, and it's just the safer route. When you're in a bull market, though, you typically see things go up pretty aggressively during some of these volatile events. Now, another thing that you can do is if you do want to hold covered calls during volatile events, you can use a portion of your premium to leverage out of the money calls for potential stock runs. You may want to buy a call using some of your premium or a strike that is far out of the money. That way, if the stock does go up, that call can help gain some of that potential increase in stock price you would miss had you just held onto your covered call and not leverage with a call. Here's an example of how I would typically choose my strike price during any given week. Is, let's say, week 1 through week 4, you see the different price movements listed here, 60 to 63, 61 to 66, etc. Overall, from that month, you will see a 2.25 or $2.25 increase in stock price over the course of a month, or let's say you run that out for a year. So then you would choose your strike, typically $2 to $4 out of the money. That way, in case the stock wants to run a little bit, you have potential to gain that equity increase as well as the profits from your premium. Now, moving on to a bear market, some of the pros are that you can sell close to the money, at the money, or in the money calls for higher premium. When you sell close to the money, at the money, or in the money calls for higher premium, that means that you can reinvest more money at a lower stock price, thus increasing your shares and being able to then quickly sell even more covered calls. So if you have 100 shares and you can quickly build up to 200 shares of a stock, that means you go from 1 to 2 covered calls weekly, increasing your potential return on your passive income. Also, typically, if you have a bear market and the cost of a stock or the price of a stock goes down significantly during the week, your cover call may already by, let's say, Wednesday or Thursday have an 80% return. I will typically sell my cover call at that point, or I will buy back my cover call. So you close out your cover call for that 80% return. And then I typically will either sell another cover call for next week's expiry, or I'll hold on and kind of let the stock do what it does for the rest of the week. Some of the cons to the bear market is that you can see big drops can be followed by big relief rallies based off some big events like CPI numbers coming out or inflation data. Company releases their earnings report and they do poorly or they do really well in a bear market, you'll see some high increase in stock prices. So that may sometimes make you lose out on potential gain in your current long-term hold. Now, another con that we may see is as prices of shares go down, the premiums go down. That's a con that we would have seen at the beginning of 2022 when a lot of these stocks that people have been holding long-term lost 20, 30+% of their value. Right now, I think that since we have lost a lot of the value in stocks in this bear market that we are in, we are actually able to start seeing some good increases in share price, but who knows what'll happen. So typically if the price of the share goes down, that means your premiums go down. And last but not least, typically in a bear market, the cover calls aren't really gaining you any equity in your portfolio. They're just maintaining the equity because they're making up for the loss in the stock price. So you will typically see more loss in your portfolio, just not as much had you not been selling covered calls. So how to choose a strike price in the bear market? I will sell at the money or slightly out of the money covered calls. That way I can make a little bit more money on the premiums while navigating, the stock price possibly falling or staying flat for the week. If there's an event similar to 2022, where over the course of 3, 4, or 5 months, the stock price decides to drop drastically, you can sell in the money or deep in the money calls. And that way you can leverage however much the stock price may drop and not lose any of your actual equity. Then you can reinvest those premiums to dollar cost average at a lower price. That way your cost basis is lower, as well as you are closer to selling even more covered calls as you build your share count. I will use far out of the money calls or puts the same way that I would in a bull market to leverage large drops or reliefs. In a bear market, you see a lot of large drops and you see a lot of large relief rallies. So I want to make sure that if that happens, I'm not losing out on my potential increase in equity or potential loss in equity. I will use some of the premium that I received from my cover call to leverage with those calls or puts, but I won't use all of it because I don't want to lose out on my weekly passive income. Now, an example that I'll show is, let's say on Monday you sell a covered call when the actual stock price is $60. By Friday, the stock price is $57. That means that I would typically choose a strike between $57 to $58. So let's say $57.50 here. That means that when the market ends on Friday and your option expires worthless, whoever bought that is giving you the full premium for that strike or for that covered call because it never went over the strike price. However, let's use an example where I would use calls or puts to leverage my covered call during the week. Let's say on Wednesday, the stock drops to $57. And then by Friday, it looks like it could possibly have a run to go to $65 or more dollars a share. So that Wednesday, I would close out my cover call, or I would buy back my cover call, and I would take whatever premium I got, which typically, let's say it's 80%, because that's usually what I aim for, is if I'm going to close out a covered call, I want it to have about 80 or more percent return. Now, you can either let your shares ride till Friday, see where the price of the stock goes, and then resell cover calls on Friday afternoon or Monday morning, or you can hold on to your cover call or sell another cover call while also selling a far out of the money call for that just in case the stock or the price, just in case the price of the stock decides to go up far past your cover call strike, or let's say it goes up to $70. So I would sell a call if I had a $57 strike. I would sell a call for $64. That way, I'm only using a small portion of my premium because that far out of the money calls are less or cost less. So I would use a small portion of my premium to leverage my account while also still receiving a significant amount of premium for my passive income. Now, my favorite condition is the flat market. When you're selling covered calls, this is the type of market that you want to see. Some of the pros are that you have consistent stock price movement, so it's easier to pick your strike price, typically close to the money or right out of the money covered calls. And then you get to reinvest those premiums at a level price. So you may not get them for a discount. You may not have to buy them at an elevated price, but typically you can reinvest them at the current price that you're willing to buy that company at. Now, the cons are none. Like I said, the flat market is the best condition for selling covered calls in. You can say that, you don't get any increase in your equity or your share price, but the whole purpose of covered call selling to me or for this channel is to create passive income. So the more consistent, the better I feel about selling covered calls. So how to choose your strike price during a flat market? Typically, I'm selling at the money or slightly out of the money cover calls, and I'm getting an increased premium for those because they are closer to the actual cost of the stock. I do not use calls or puts to leverage whatsoever. That's a bad idea. You will lose money because by the end of the week, you will have those calls or those puts expire worthless. An example of a flat market kind of strike price or movement would be on Monday. Let's say the share of your stock is $60. During the week, the shares move $59 to $61. And then by Friday, it ends at $60.50. So here I would choose a strike between 60 to 62 on Monday, knowing that the cost of the shares may trade flat during the week and I get the most premium. Please feel free to follow along so you can see my current example accounts. I'm using a $2,500 account to get it to $10,000 in 1 year using only covered calls and the covered call strategy. I'm trying to as well using my $40,000 account right now to make $2,000 or more a month. That account is constantly growing, so let's see how far we can go. And I'm trying to get the $2,500 account to $100 a month in passive income. That way I can show you that you don't need a large investment to start this process of covered calls.